Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, March 18th. The Federal Reserve's Open Market Committee today announced a cut in the overnight federal funds rate target from 3% to 2.25%. This 75 basis point cut was generally expected. In fact, there was talk that the Fed might cut rates by a full 1%. In addition, the Fed also announced a further 75 basis point reduction in the discount rate to 2.5%. The Fed funds rate cut is huge from a historical standpoint. In that respect, there might be some criticism of the move and that it might be seen as leading to inflationary pressures later this year. Some might also suggest it reflects a degree of panic on the part of the Fed. From a real-world standpoint, however, the rate cut is totally justified. The current yield on the 3-month Treasury bill is just 0.86%. The yield on a 6-month bill is 1.22%. Even the yield on the 2-year government note is just 1.47%. All are still under the new Fed funds target for overnight loans of reserves between banks. This rate cut doesn't even bring the centrally determined Fed funds rate down to current free market rates. Of course, the Fed doesn't want to simply mimic market rates, as that could lead to significant volatility in Fed policy. Nevertheless, the reality of the current market environment fully justifies the current rate cut, even though it appears drastic. Furthermore, the rate cut is clearly warranted in terms of providing economic stimulus. The housing market remains very weak and economic risks remain to the downside. The Fed is cutting rates to provide necessary support to a fragile economy. As to inflation, the Fed noted that the inflation outlook uncertainty has increased. This reflects perhaps concerns about the potential for rising inflationary pressures in the months ahead, but that obviously was overridden by the Fed's current desire to give the economy a boost and to ease credit market conditions. The financial market reaction is far from certain. The stock market has frequently been subject to violent swings following rate cuts and significant selling after some cuts. This rate cut won't solve all the problems in the credit market and may not help many financial stocks, but it is hard to see how it doesn't ultimately help many stocks. I'm Pat O'Hare for Briefing.com. Thanks for listening.